What is up, everybody? Today we're going to talk about rules of self-directing your retirement account. Now, not a super sexy topic, I'll admit it, but I promise you get value out of this video, and these are important items that you need to know if you are going down this path. So, if you're in here wondering what is this self-directed retirement account, so SDIRA, well, I had a first video on that with this series. I'll put the link in the description below. You can take a look at that. It'll open your eyes to what it is and what are the possibilities. But real quick, as a refresher, so SDIRA, it stands for Self-Directed Individual Retirement Account. And really, when it's all said and done, what you're doing in this type of account is you are in the driver's seat. You are taking control of your retirement account and where the trajectory of that account is going to go. So super impactful. You can invest in things outside of stocks, bonds, and mutual funds. You can invest in real estate, crypto, the list goes on. It's awesome. Killer strategy. But accounts, what are the accounts we're talking about here? You guessed it, 401ks, your IRAs, your Roths, your HSAs, your Coverdales, the list goes on that as well. And what do these have in common? So they're all tax advantaged accounts. So again, that's a brief refresher there. Now these rules. One thing I like to get it started with is kind of an analogy of Monopoly. Most people in here, most people have probably heard of Monopoly, I hope. So in Monopoly, what do you have? So you've got your go here. And you're going to go around the board game. You got boardwalk, so on and so forth. Say in this corner, you've got jail. You can go to jail. Going through here. Now with Monopoly, if it's your first time playing, are you not going to look at the rules? No, you likely are. You're going to take a look and be like, hey, how do I keep to my objective of winning this game? How do I keep going through, pass and go, collecting my money, picking up properties, and avoid going to jail? Breaking the rules. So how do I avoid that? Again, that first initial time, you're going to read through those rules, but once you keep playing it, I mean, it's kind of just second nature. And really, in all reality, they're simple. Same thing over here. All these rules, they're simple rules. It's just important. They are very important that you need to know these before you're getting into the game. So that's that. Now, another thing, in regards to rules, now each of these rules, they are associated with some sort of law. Now, it's not going to be like, oh, I break a rule, I broke the law, and ding, 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 Josh broke a law. I'm going to go dissolve my retirement account, so on and so forth. No, this is something where you may have broken a rule and you're not even aware of it. So that's why it's super important to know these before getting into this game, because it could be 3 years down the line, you get a tax audit, IRS looks into it and they see, so wait a minute, what were you doing with your retirement account? Oh, did you not realize that was a prohibited transaction? Oh, you didn't? Well, guess what? It's not going to be a slap on the wrist. It's going to be, we're going to backdate to where that infraction was. You're going to pay all those back taxes. You're going to have early withdrawal penalties. You're going to completely dissolve your retirement account. It's going to be a huge mess. So again, I'm not trying to scare you, but these items are extremely important. You got to go in eyes wide open. It's not scary. These are simple rules. Just be aware of the consequences. So with that, first rule, what we're going to get into is titling and ownership. So what do we got here? So with this, you've got to change your frame of mind when it comes to retirement accounts. So one of my retirement accounts, it's a Roth IRA. It owns a duplex south of Nashville in the Bellevue area. Now it owns it. So I can't go and say like, oh, I own a duplex in Bellevue area. No. My retirement account owns it. So just reframing it that way, because everything that you buy within these accounts has to have your retirement account on title, not you in any way, shape, or form. So let me give you an example of this. So right here, we've got, say, an institution. Draw it here with the 3 pillars. Again, my artistry skills are not the greatest, but that's your pillars. This is your custodial account, so your custodian. Now there's multiple ones of these. Again, this is just, it's like your Fidelity, Vanguard, Schwab's. It's a custodian that will allow you to direct your account in this manner. So it's not going to be those big name ones. Mine is called, they're actually called Directed IRA, funny enough. So Directed IRA. So this is a custodial account that has my retirement there where I can self-direct. So with this self-directed account, I have the account opened for example purposes. This is my traditional IRA account. Now with this IRA account, what it owns a company. It formed a company over here. And we'll just call this the Bee's Knees Company because this is an awesome strategy. We'll get into, we'll do a deep dive video on this, exactly what the structure looks like and how you can do it yourself. But this is just for example purposes here. So Bee's Knees LLC. So as far as that duplex, like I'm referring to, this would purchase that duplex. Now who's on title for that duplex? For that duplex, Bee's Knees LLC is going to be the title there. They're going to be on title for this home. It's not going to be my name in any way, shape, or form. Now you can go more of the direct route, and depending on how many transactions you do in your account, this might make more sense. But you can go directly from that company with your IRA, and it's going to be your IRA that owns it. Now, in this case, it's still your IRA on it. What this is going to show up as is you're going to see 100% ownership of this company is going to be, it's going to state something like directed trust company FBO, so for benefit of Josh Smith IRA, and then your account number, so on and so forth. So everything is owned by that IRA. You can't have ownership. You can't have your name on title for anything. You can't have any of the debit cards in your name, all that stuff. Well, debit card, it's going to have your name on it, but it's going to be under the company. But anyways, the title on any assets that you own cannot have your name on them. So that's that. So next rule is account purpose. So what are the purpose of these accounts? So they are in for investment purposes only. So you've got investment, we'll abbreviate that, investment only. Now, what do I mean by that? So these are assets that you're investing in. So for like a simple example, say you purchase a vehicle within your retirement account, which guess what? You can. With self-directing, you can purchase a vehicle. So we've got our vehicle here. Some form of SUV, some boxy SUV. Maybe it's a Bronco, who knows? I'm not an artist, as you can tell. So this vehicle, now account purpose is investment. Can I go use that vehicle? Absolutely not. I cannot use that vehicle. So if I purchase this within my retirement account, again, back up here, it needs to be titled in the name of my retirement account. I'm not on title in any way, shape, or form. But I also can't use it because that's going to cause another issue here down the line. And we'll talk about that. But as far as how can I actually utilize that vehicle within the retirement account? Well, what I can do is put it on, I can administratively manage it to where I put it on, say, Turo. So Turo is like the Airbnb for cars. So you can put your vehicle on there, rent it out to people on like a short period of time. But yeah, so you got Turo. Again, I'm over here and I am just the administrator setting this all up. Now someone comes and some third party over here, they come to rent it. They're going to rent that car. They're going to pay the retirement account or whatever structure you have set up where that retirement account owns. They are going to pay into that. They cannot pay you personally. You never pay you personally and then go to that. It's always straight to the retirement account. So again, investment purposes only, and it needs to stay within the retirement account. So that is account purpose. Next one we got is separation. So separation here, it's just like your personal finances and a business. So say we've got our personal finances over here, put a dollar sign. This is personal. We'll put P for personal. And on this side, we have got a brick and mortar business. Brick and mortar business. So this is business. Now on that side, you're going to have your personal banking accounts. You're going to have your personal credit cards, so on and so forth, all your utilities, your business. These funds should never commingle. Again, that's just good business sense. Now, if you don't have your business set up like that, you should, but really, it's much cleaner. Some people may think, oh, this is more difficult, more accounts to keep track of. Honestly, it'll make your life so much better, especially when it comes to tax season. I tell you what, your CPA will love you, so on and so forth. But you want to keep all of these accounts separate. No commingling. Retirement accounts, it's the same thing, except that there are laws in place where it must be kept separate. So in this instance, you're going to have SDIRA. That's essentially going to be the business on this side. It's going to have its own account, the retirement account. Now, if you have a structure like I was mentioning before, where it's within an IRA LLC, then that's going to have its own business checking account, so on and so forth. Your personal funds never go to that account unless they'll go to the retirement account custodian when you're funding it. So you've got contribution limits for each year. Like say for Roth, I think this year it's around $7,000 for the year. That you can contribute to the account. But outside of that, like you can't pay for, say you've got real estate in an account, you can't pay for the utilities yourself. You can't pay for a handyman to go over and like, hey, I'm going to get a reimbursement from the account. You can't do that. Every transaction has to stay within this box. So no commingling, everything stays within the retirement account, operating within the retirement account. So that's that. No commingling, very important. Now that brings us to number 4, self-dealing. So what do I mean by self-dealing? So we've got no self-benefit or use. So no self-benefit or use. So an example here is say we've got a vending machine. You've invested in a vending machine, and guess what? You can invest in a vending machine with your retirement account. It's crazy. It's like the possibilities are endless. So here's this nice little vending machine, and say, you know what? I am really jonesing for Reese's peanut butter cups. I love Reese's. I can't get it from this machine because my retirement account owns it. So say I've got my IRA. It owns this. I cannot have a benefit from that. So I cannot purchase anything from that machine. I cannot benefit from that machine personally. I cannot use it. So that's kind of a very rudimentary example of that. Now, another example for this could be, say you own real estate and you want to manage it. Well, if that's fine, you can administratively manage it, and we'll get into that a little later. But as far as that goes, you cannot pay yourself. You cannot have a benefit from that personally. Everything has to be within that retirement account. You can't pay yourself within that, even within that retirement account. It's not a lot. Well, you'd essentially be transferring you'd be transferring the money from that account to the account. Yeah, that's ridiculous. But anyways, you cannot pay yourself within that account. So no self-benefit or use, self-dealing. So a lot of these, when we go down to this, they're all classified as prohibited transactions. Again, it's not necessarily the rules on the accounts themselves as far as how do you contribute to them, so such like that. These are how you transact within your account. This is what you're allowed to do within your account, how you need to conduct business. So again, self-dealing, that's a big no-no. Number 5, this is a big one. So disqualified person. So what this is who can you transact with within your account? So you've got your IRA here. Again, This is any retirement account. I'm just putting IRA for examples. So who can you not transact with? So here it's going to be yourself. Again, that goes to self-dealing. So yourself is there. So you, your children, child, and we'll put here your spouse. Cannot invest with your spouse. And third one is in the tax code, it's called ancestors. So what that means is your parents, your grandparents, all that ancestral lineage you cannot invest with. So ancestors. Now, there are structures. There is somewhat of a workaround on this. Again, it's a little more, it's somewhat complex, not crazy, but we'll go do a deep dive video on what that could look like. It is restrictive, it's more restrictive, but you can, there's ways of getting around this. But in all intensive purposes, let's just say these are the ones you cannot transact with. Yes, there's structures, but that's complicated. That's a bit of a rabbit hole. We'll go down that. But for now, just know you cannot transact with yourself, a spouse, your children. Forgot to put in here your children's spouses, or your parents, grandparents, so on and so forth. Now, who can you transact with? So what's okay in here? So oddly enough, I mean, you can see here, this is all familial status, but for some reason, the IRS is like, well, guess what? Your siblings, they're not family. You don't like them anyways. Oh, it's funny. But yeah, oddly enough, siblings, they're totally fine. You can invest with your siblings. That's fine. Same goes for your spouse or your sibling spouses. I mean, sibling spouses, totally okay. And guess what? Your in-laws. You can invest with your in-laws. That's totally fine. Now, funny one here, say children. They're in the dating stage. That person is not yet a spouse. That person is a boyfriend or girlfriend. Now, can you invest with them? Technically, yes. You can invest with them if you want. I'm not saying you would want to, but you can. Now, I probably wouldn't advise to go that route, because guess what? If you start investing with them in this stage and they later down the line, granted, I mean, there could be bad blood there anyways. I mean, that sounds like kind of a nightmare within itself. But say they do decide to get married. Well, then they come over here. They're now in this box. Man, I'm running out of ink. They're now over on this side. And with that, retroactively, what you did before, that was okay. But now everything comes over here and the account becomes much more restrictive. Whatever your partnership was before, you now cannot change. If you were a 60-40 split, nothing can change. You can't buy each other out. You can't do any of that. And if you want to just get out of the account, you both have to sell. So it just makes it more restrictive, and it's not ideal. So wouldn't really suggest this. Again, you can do whatever you want, assess your own risk, but yeah. Well, this is with all the familial status. So now outside of that, who else can you invest with? Pretty much anyone. You can invest with anyone as long as they do not fit within this box. So we'll put anyone, but it does have an exception. With exception. Now, what's the exception here? Who you partner with. That brings us to the partnership rule. Rule number 6. So as far as partnerships go, say you're partnering with a company that you have ownership in. If your ownership is 50% or greater, that's a no-go. You can't partner with that company. Say you have a general contracting business or some handyman business, something of that nature, and you're 50% or more partner in that, you can't hire that company from your IRA to do any work. Again, that's kind of, I mean, it breaks a couple of rules. I mean, it's self-dealing, so on and so forth. So that's a no-go. Now, if you own 49% or less, that's okay. So if you own 49%, technically, as it's written, you can invest in that. Now, there is some gray area in here because there's not really been anybody that's kind of pushed the limits on this, on right at that 49%. Really what I've seen from others that are like really good within the space is they're trying to stick below 30%, like safe. If it's less than 30%, like, okay, yes, I feel more comfortable partnering with that company. But within that, you can't, within that, there's a lot of guidelines and minutiae you got to go through. So you definitely want to consult an attorney if you're doing anything like this. It is a more advanced strategy. Just be careful. Just make sure you know what you're doing when you're going down that route. So that's partnerships. And that kind of leads into compensation. Now, compensation, that's also, I mean, that's kind of intertwined with self-dealing. You cannot compensate yourself within a retirement account. So say you have a property. Again, I'm in real estate. That's a lot of my examples. That's what I'm good at. So compensation, say you have a property and you want to manage it yourself. We used this example before. You cannot pay yourself for the management of that. You can also say you want to set up the furniture in that property. Maybe you're doing a monthly furnished rental. You can't pay yourself to do that job. Just can't do it. So compensation, that's a no-go. Sweat equity, it's kind of in the same vein there. So sweat equity this is what I was talking about in reference to administrative management. That's what I like to call it. So you got administrative, so we'll do admin, management. Pretty much everything you do within this retirement account or your retirement accounts when you're self-directing, it's going to be administratively managed. You're not going to be involved like actually doing the work. You're not going to work on, say, a property. You're not going to work on that property. So you can't go to the property and fix a leaking sink or something like that. Or you can't go to the property, like I said, set up furniture. You cannot do that. So it's administrative management only. So important note there. So no sweat equity in the deal. Again, a lot of this goes and ties back into the self-dealing. There are variations of the self-dealing. That's like an overall encompassing prohibited transaction that you can't do. So with that, we've got credit. So yes, in your retirement account, you can actually leverage a loan, credit, or leverage a loan to purchase a property. But there's some caveats. Now, again, you're probably not surprised by this, but credit, when it comes to self-dealing, you cannot be the personal guarantor for that loan in any way, shape, or form. So therefore, you cannot use your credit score to get a loan. Everything has to be for that retirement account. Going back to that. So you can't use your credit. You can't use a personal credit card. You can't use any credit card because that's going to use your credit score. And you can't even use a credit card for, like, say, a company like that structure that I was mentioning to you. Maybe way down the line could, but I haven't seen cases. Really, your best bet is going to be to use a debit card for that business. But again, later video, we'll deep dive into that, how that's structured. But credit, can't use a credit card. You can't use a mortgage within your name. That's a no-go. So, but you said I can leverage within these accounts. Yes, you can use what is called and we'll put a check mark next to this, a non-recourse loan. Now, non-recourse, what does that mean? So non-recourse is going to be where you are not liable in any way, shape, or form to pay back that note. So it's going to be backed by some asset and purely just that asset. It's not going to rely on your credit score. They can't pull your credit score, anything. It's going to rely fully on that asset. So non-recourse. It's not a huge amount of lenders that do this, but there are some. And important thing to note about this is the down payment's a little high. So traditionally, say you go to purchase a home and you put 20% down, or maybe even you get an FHA loan and you're putting like say 5% down. Great. You've got less into the property. It's a little more affordable at that point. Granted, your payments might be a little higher, but it's at least a more affordable entry. Now with a non-recourse loan, that down payment is going to be 40 to 50% on average. That's a lot of money. That's, especially as an investor, that's going to kill your cash flow. That's going to kill your return. So not exactly ideal. Granted, you'll still get a piece of real estate within your retirement account. That's awesome. But that's, from an investor mindset, that's painful. That's brutal. I wouldn't want to do that. So what's the way that I've done it? So through seller finance, or subject to. So seller finance, that duplex that I got is a seller finance. And with that was within a Roth IRA. And I've got a video on that breaking down that whole deal. I'll put that in the description as well. But it was within Roth IRA. It was a 5% down payment, no payments for the first year, and then interest payments after that until it balloons out at 8 years. So crazy stuff there. So seller finance, that is much more affordable. You can get that to cash flow. That's a good route. Now, one important item that you need to refer to when you are leveraging within your account some type of loan is you're going to be paying something that's called UDFI. What is that? That's unrelated debt financed income. So what this is essentially is a tax that you have to pay on the portion that is being leveraged or financed. So there's ways to reduce this within the account through expenses, stuff like that. But UDFI, you will have to pay a tax within your retirement account, which is kind of crazy. You're gonna have to Roth. I mean, you're growing tax-free, but yes, there's still instances where technically when you're self-directing, you may have to pay tax. So UDFI, there's another one called UBIT. Now this isn't related to financing. Again, we're gonna have a full video breakdown on just deep diving into this subject and kind of use cases, because it's not like a crazy topic, but it's gonna take probably 15 minutes or so to really deep dive, make sure you fully understand it. But UBIT is called Unrelated Business Income Tax. Now this is if you finance. This one is if you're running an operational business within your retirement account. It's not passive. So they don't want you to have an unfair advantage over any other small business. So if you're doing an operational business within your retirement account, which you can do, that business is going to pay UBIT, which is going to be, it's north of 30%, but that's a tax you have to pay on your earnings within that business. So important things to note there. Again, credit, can't use your own credit, can't personally guarantee anything. You have to get credit in other ways, other creative ways. But if you're in real estate, that's what's awesome about real estate. You can get super creative. It's awesome. Number 10, probably my favorite. And this isn't necessarily a rule. This is just like an awesome part of these accounts. And really the way you should think about these accounts is invest in what you know. And this is awesome. This is a superpower. It's great. I can't express how great this is. Because when you're in a normal retirement account, again, you've got stocks, bonds, and mutual funds. You may not know anything about that stuff. The vast majority, honestly, they really don't. This is where you can supercharge because you're investing in where you know. These are areas where you are, say it's your niche, or say you are plugged in. So you're well connected. So again, when you're self-directing your retirement accounts, it's very important. You really want to invest in what you know, something where maybe you've proved that you've made profits on it. Again, for me, that was real estate. Other people, it may be something completely different. Maybe you're really good at cattle ranching. Guess what? You could buy cattle within a retirement account. It's crazy. I tell you, the list goes on and on. But real estate, that's my niche. That's where I've proven I can make money. And that's where I've proven I can make way better returns than I would in a traditional account. Again, traditional accounts, you're going to be, on average, if you've got say a mutual fund tracking the S&P, 8 to 10% if you're lucky. And in these accounts, consistently, I'm always over double-digit returns in real estate, more often than not, 20% plus. So that's great. So invest in what you know. That is an awesome, I can't tell you enough how awesome that is. Again, if you're getting into these accounts, I highly suggest invest in what you know. It's going to work out so much better for you. That's what's exciting about this stuff. But one last thing, kind of some advice. Now, keep in mind, especially if you're in the real estate space, again, I'm going to be bringing this back to real estate a lot because that's where I've seen my success in these accounts. Again, yours may be something completely different, but if you're in real estate, you may have people telling you, why would you purchase a property within your retirement account? That doesn't make sense. You're going to make much more money outside of the retirement account by purchasing that real estate in that way. Because yes, you're going to have depreciation, you're going to have write-offs, so on and so forth. You can write off travel to go to that property. I mean, there's the benefits to owning it outside of your retirement are endless. Yes, you likely in most cases are going to make more outside of your retirement account with that real estate asset. But what you got to keep in mind, just think, we're in the IRA lane. We're not thinking about outside the IRA. What can we do within your IRA? So think about it this way. So say I lived in DFW for a period of time. So they had a ton of toll roads. And next to those toll roads are these little frontage roads. And all these frontage roads, they had stoplights from here. Toll road, obviously, that is no stoplights. You're paying to be on there. Now, these are going down the same exact path. Again, these are all, we'll do F for frontage. These are all within the IRA lane. They're all going down the same path. Now, guess what? I mean, if you go to toll road, are you going to get there much faster? Maybe better returns? This is self-directing your retirement account. I know when I self-direct, I'm going to get to my destination, the returns I desire, faster than I would the traditional route. This traditional route, again, you've got some random ETF or mutual fund or stocks, bonds. You're not going to get there as fast. They're decent. You can get decent returns in that market. Again, there's some people that they're really good at stocks, but the vast majority of us, we could care less. We're like, oh, it's a retirement account. I guess I'll put it in this. I mean, but this is much more exciting. You're much more involved. And again, it's investing in what you know. You can get to your destination much faster. So that's what I've got to say to that. I'm going to be making a 20+% on this, where this is like an 8. Okay, man, that's a little uppy. 20+% on this. And this is maybe an 8 to 10%. Again, I'd rather go on the tollway on that. Again, when you're just thinking about IRAs, real estate, for me, or other assets that it's going to be better. You're going to be going down this tollway if it's something that you know and you've proven returns there. Now, keeping this in mind, there may be instances where you could invest in real estate where really it is better within a directed retirement account. Like say that duplex, or say you get a property that is crazy undervalued and you buy it within your Roth retirement account. Well, all the growth in there is tax-free and you're taking it out tax-free at retirement. That's crazy. So if you get it super undervalued and you've got a crazy spread when you go to sell it down the line, guess what? You don't have to pay any taxes on that. And that might, depending on the deal, might equate to much more return than it would have been the traditional route. So take that into consideration. There's multiple ways to skin a cat, but if somebody's telling you, hey, you shouldn't do real estate within your retirement account, that's what they're referring to. Yes, you can make more money on average with real estate outside of your retirement account. But when you're just thinking, how do I make more money in my retirement account? Invest in what you know. That's how you're going to do it. Now, other set of advice. I'm not an attorney. These can be advanced strategies. I don't know your personal use case. So yes, I've done a lot of research on this. Yes, I'm super passionate about it. I love this stuff, but for your individual use case, it's always good to consult an attorney or a custodian that they specialize in this space. I'm firm believer of you are the captain of your own ship. You need to make sure you have the knowledge and wherewithal going into this before you just jump in to, I mean, yes, jump in, learn things, but these rules are extremely important. Make sure you're consulting somebody that is highly well-versed in this space. I'll give you some context, at least of who I used to get into the space, like who I use for my custodial account, and as far as my attorney. I'll put those links below just so you have them. And yeah, outside of that, that's pretty much it. There are additional things you got to take into consideration, but really, these are the main key rules that you really need to make sure you're watching when you are transacting within your accounts to make sure you're staying within this. Again, if you don't stay within these rules, you could dissolve your account. It could get ugly. It's not fun. But I hope this video was helpful for you. Again, it's a lot of fun for me. But if you have any more questions, if there's like an individual question, I'm more than happy to help you out. Again, I want to help you be successful in your future. I want to help you build that generational wealth. So I'm going to put my Instagram right here, and yeah, feel free to DM me on there, and I'll see what I can do to help you out. But if you like this content, we are going to have more of this content. So hit that like button, subscribe, and we'll see you in a future video.